So we move into our second chapter on CGT, chargeable gains, chattels, land and buildings. Now in this particular chapter we build on the first chapter, chapter 12, basic principles, and we talk specifically about these assets. In other words, these assets have specific rules where they are disposed of. Nothing overly complex, but just we need to do our question practice to get up to speed. So let's talk first off in section 1 here about the disposal of something called chattels and wasting assets. Now you'll be sitting there thinking, well, what are they? I'm just about to explain what they are, don't worry. So, terminology. A chattel, is basically tangible, movable property. In other words, you can touch it and feel it and you can move it, okay? So, for example, assets such as furniture, works of art, vehicles, jewelries, animals, okay? Now, note, they are distinguished from land and buildings because you can move them. And indeed from securities because they're tangible. You can't touch a share, can you? So there's the definition. Okay, don't worry about sort of memorizing that. We're more interested in the mechanics and the numerical side. Okay, so that's a chattel. What about a wasting asset? Well, a wasting asset is an asset with a predictable useful life of 50 years or less. Okay, typical example might be a short lease. Or indeed, let's say something like a greyhound, a racehorse, etc. They are wasting assets as well as being chattels. Okay? So there's the terminology. How does this manifest itself in terms of computations or calculations? Now, there's a lot of information here. I'm going to make it slightly bigger, and I'll just show you, if you don't mind, the diagram first, and then I'm going to work through it. Oops, lost it. Now, this, and indeed all the information obviously within each of the mind maps, is taken directly from the study hub. So you can, you can go in and move and shake around the study hub, but I do think my explanation may well sort of open this up a little bit more than the study hub actually does. So, as I say, just a quick look at the diagram first. Now, note, we're talking about the disposal of chattels, the first asset that we saw in the definition above. Okay, so what's the deal here with this diagram? It looks like there's quite a lot of information in it. Well, what it says here is there's 4 situations. Okay, so you might think of these as like perhaps 4 different chattels, and 4 different scenarios, where the proceeds and the costs are different, 1, 2, 3, 4. And what the narrative does below is sort of take us through each of these different scenarios or indeed situations. Okay, now a couple of things to point out to you other than what I've just done. You'll see here the number 6,000. So £6,000, So if you will, in the middle of the diagram, that's the £6,000 line, Take that as the £6,000 line, okay? Now what I'll do now is work through, based on the narrative below, again, it's just cut and pasted from the study hub, situation 1, then 2, then 3, then 4, okay? I hope that makes sense. So I'll make this slightly smaller so we can actually read the text as well. Okay, so what we see here, it says in situation 1, where both the gross proceeds and cost are greater than 6,000, the computation is just a normal chargeable gain or allowable loss. So in other words, I have a chattel, I dispose of it for 8,000. What did it cost you? Well, it cost me 7,000. Just do a normal calculation. Remember from part 1, a 3-liner, proceeds less cost equals gain. So this situation 1 is straightforward. There's nothing to that. You'd be thinking, well, maybe this isn't as bad as I thought. Okay, well, it gets a little bit more complicated as we move through the situations. But there's one for you. What about 2? Okay, 2 is quite straightforward. Here it says the gross proceeds. Now, when we say gross, we're talking about inclusive of any fees, like an agent fee or some sort of fee. Okay, so gross proceeds and cost are both less than 6,000. Note that this scenario, the situation is below the 6,000 line. So actually, in this case, yeah, the gain or the loss is completely exempt, irrelevant. Yeah, we don't bring it into play at all. Okay, so let's look down at the narrative. Really, in effect, yeah, completely exempt, nothing to do. Nothing to do. So situations 1 and 2 aren't too bad. Easy to deal with. We're just looking out for a chattel. Remember the definition above, maybe a work of art, etc. Yeah, and indeed both above the line, just normal calculation. Both below the line, either a gain or a loss, whatever occurs, is exempt. Not interested. End of story. Okay. Let's now move to situation or scenario 3. Okay. Now, in this particular case, let's not forget the line. Yeah, the proceeds are above 6,000 and the cost is below. So clearly that's going to be a gain, isn't it? If I've got proceeds of more than 6 and a cost of less than 6, it's a gain, but it's subject to what we call marginal relief. Okay. Now, what do we mean by this marginal relief? Well, this is what it's explained here. Okay. So it says, in situation 3, gross proceeds greater than 6, cost less than 6, the chargeable gain is the lower of the gain normally computed and indeed 5/3 times gross proceeds minus 6. So we're talking about the gain normally computed, number 1, or this gain. So it's the lower of the two. So in actual fact, in this scenario, I'd have to do 2 calculations. I'd have to go up top and say, okay, sorry, you said the gross proceeds are more than 6. Yeah. The cost is less than 6. So we have 7,000 gross proceeds, cost of 3. What's the gain? Yeah. Well, the gain is 4. Well, let's compare that to the calculation, which basically says 5 divided by 3 gross proceeds. Yeah. Remember, 7,000 less 6. That gives me 1,000 multiplied by 5/3. I haven't done the calculation in my head, but you get the drift. Yeah. So we're saying that the chargeable gain is the lower of what you compute using either 1 or 2. Okay, that's it. So that's number 3. Again, not too bad, a little bit fiddly, but not overly confusing. Now here, number 4 is sort of, in one sense, the reverse of number 3. Yeah, because here what we see in situation 4, scenario 4, is that the cost is above 6,000, but the gross proceeds are below 6,000. So clearly in this particular case, this is going to be a loss, which is allowable, but the loss is limited to a reduced amount. What do they mean by that? Well, let's look down. Situation 4, cost greater than 6, proceeds less than 6. The allowable loss is restricted by substituting deemed gross proceeds of 6,000 for the actual gross proceeds. Yeah, relief still given for the actual incidental cost of disposal. So you'd be thinking, what do you mean? What do you mean? Well, what I mean is where you have this situation based on the normal numbers, you actually slot in 6,000 and in effect get the allowable loss. So you replace the actual proceeds, remember they're below 6, yeah, with 6. So in one sense, this scenario or situation 4 restricts the loss, doesn't it? Because if I have, let's say, 8,000 as a cost and indeed 4,000 as proceeds, I've got a loss of 4, haven't I? Yeah. But if I'm required under these rules, and I am required, to substitute the gross proceeds of 4 for 6,000, then I'm making the loss lower. I'm making it only 2 rather than 4. So if you will, this scenario, number 4, restricts an allowable loss, and this one restricts a chargeable gain. Okay, so there you have it, 1, 2, 3, and 4. All of these notes, as I say, relate to chargeable disposals of chattels, defined as we saw above. Now, you'll be thinking to yourself, okay, well, how do I spot this? By doing questions, you just get familiar. You'll see a work of art. You'll see this. You'll think, that's a chattel. Therefore, one of these rules is going to come into play, if that makes sense. Okay? So, that's the area that concerns those 4 different scenarios. What about the chargeable disposal of a wasting asset? Okay, now there's several types here. So a wasting asset, as we said up top, is basically an asset that over the course of its life wastes away. And there's 3 main kinds. Okay, firstly, chattels not eligible for capital allowances. They are exempt from CGT. Chattels eligible for capital allowances and other wasting assets. Okay? Now, in terms of detail here, wasting assets that are not chattels. So, for example, copyrights. Remember, a chattel is tangible, movable property. You can't touch a copyright, can you? So, wasting assets that are not chattels are chargeable assets. Yeah? The computation note of the gain or loss compares the current proceeds value with the unexpired cost of the asset, where that cost depreciates evenly over its useful life, not exceeding 50 years. So, what do I mean by that? Well, I mean that, okay, someone owns a copyright, okay? Now, as far as we're concerned, for CGT purposes, a copyright is a wasting asset, yeah? Its value, and indeed its costs, wastes away over time. So therefore, if we have a situation where we sell it, we must make sure we have the right cost. And if its cost wastes away, let's say over 50 years, then the cost that we would use in a calculation in a 3-liner must change. So how do we do it? Well, we simply say, okay, well, what was the cost? What's the remaining number of years of useful life? Oh, only 8. What was the total estimated useful life? Well, it was 50. Okay, so 8 over 50 times cost, yeah? So you'll see that as time moves on, in effect, the cost that you can include in your 3-liner for wasting asset disposals gets lower and lower and lower, okay? Hope that makes sense. A little bit tricky. Let's do the questions. Now, disposal of land and buildings. Remember, as I said, when I introduced this particular chapter, I said different rules for different types of assets. So, in terms of land and buildings under the TX UK banner, basically either freehold, yeah, or short leasehold. In other words, a lease of 50 years or fewer. Okay, those are the 2 types. There are others, but they're not examinable under TX. Now, first things first, part disposal. Now, this is certainly a popular area in the TX exam. The examiner likes this, and in the main, I think students are okay with it. Okay, so in essence, what I'm talking about here is, let's just say that you have a plot of land and you dispose of some of it. This would be the scenario. Okay, so I'm looking, yeah, to find out what the attributable cost is to a part disposal. So I have 100 acres, I dispose of 20. Well, this is how I would deal with it. First off, where A, yeah, is gross consideration. I'll come to the fraction, you'll see it at the bottom there. I'll make it a little bit bigger in a moment. So I've got, number 1, I've got A, gross consideration, yeah, of the part sold. So for example, 20 acres, okay? B, the market value of the remainder of the asset at the date of disposal, okay? Now, you'll be thinking to yourself, well, wouldn't you just prorate it? Not necessarily. Because so imagine a scenario where someone owns, let's say you, 100 acres of land, yeah, and it's in a prime spot. You sell 20 acres, we need to use the part disposal rules. But because you've sold 20 acres and someone's going to build a set of flats, it impacts disproportionately on the balance. In other words, the other 80 80 acres. So in essence, what we need to do is we need to recognize that when you part dispose of something, it may well be that the balance isn't just proratable. Okay, that's the key point. Now I'll open up the fraction in a moment down below, but just take it from me that A and B have got to be slotted into the formula below. Okay. Now, in terms of the formula, yeah, if you take a look at it, let me just make this slightly bigger. That'll do. Okay, so we have this calculation or this little fraction. It says the attributable cost of a part disposal is calculated using the formula. The cost, i.e. the total original cost, A over A plus B, where A is gross consideration of the part sold, B is market value of the remainder. So think about it, the gross consideration of the part sold, and immediately on that day, the market value of the remainder. Really, if you combine the two, we're talking about total market value, aren't we? So really what we're trying to do with this fraction, yeah, is extract out of the total original cost for the 100 acres, what value is relevant to the part disposed of. And we get that value by using what you sold it for, because if you sold it today for 500,000 and the market value of the remainder, the 80, is 800,000, then you have your fraction. Okay, so in essence what I'm trying to impose upon you or remind you is we don't prorate. Yeah, we don't say, oh well, you sold 20 acres, it's 500,000, therefore the balance must be just worth 4 times that, so 2 million. No, we use this formula. Okay, so a little bit tricky, but again, once we do the questions, we get better. Another area, different. This is private residence relief. So we've left now chattels, wasting assets, and we've also left land and buildings. Got their own rules. What's the deal here? Well, private residence, what are we talking about? Well, we're talking about someone's home. We're saying that the taxpayer's home is exempt on disposal if it was occupied by the owner throughout the period of ownership. So I buy a house, yeah, in 1990. I live in it for 20 years until 2010. I sell it. I make £1 million, exempt, because I was living in the property. Yeah. Now the other scenario is it was occupied at some time by the owner, yeah, for the period of ownership, but it also includes some periods where perhaps it was not occupied. So the whole conundrum here, yeah, is yes, completely exempt, yeah, if it's occupied from the point of purchase to the point of sale, or if it is occupied at some point, but these what we called deemed occupation periods cover the whole 9 yards. Now, in what situations would the gain not be exempt? Well, if you've got periods that aren't covered by deemed occupation, yeah, as we'll see in a moment. So what are we talking about? Well, we're basically saying, okay, this is a relief that relieves a taxpayer in a situation where, in fact, for part of the period of ownership, he wasn't or she wasn't living in the property. Because if you weren't living in the property, you let it out, then part of the gain when you dispose of it is going to be chargeable, or it's not covered by what we call deemed periods. So calculating this relief is along the following lines. So where there has been a chargeable gain, there's been a period of absence, yeah, what we need to do is follow these steps. In other words, these steps lead us to the situation where we can split the overall gain between a chargeable gain and an exempt gain. So first off, what do you do? Okay, so we see in the question scenario, John bought a property in 1990, lived in it for 15 years, and then went to live with his mum for a couple of years, and then came back reoccupied the property, and then sold it in 2010. So I'm talking about that style of scenario where the individual is not living in it all the time. So what do you do? Well, first off, just calculate the gain on the property as normal. Yeah, just normal three-liner. Proceeds less cost equals gain. Okay. Second thing, the total period of ownership calculated. Well, 1990, let's say 1st of January to the 31st of December 2010. So basically 20 years. We would do it in months. Okay. Next area, calculate the periods of occupation, yeah, including deemed occupation and non-occupation. In other words, look at that 20-year period and say, okay, well, he lived in it for 15 years. Okay, so that's a high proportion of the 20 years. There's also maybe some deemed occupation, more of that in a moment, but for a couple of years, it's non-occupation. So some part of the gain, let's say 2 years out of the 20, yeah, 2 over 20 is going to be chargeable. Now, once you've split in relation to this 0.3, the area of 0.1, i.e. purchase, to 0.2, sale, then you can come up with this fraction. So there's the total gain that was calculated here. That was easy. Then what we do is equate this fraction, periods of occupation, i.e. here, over total period of ownership. So really what we're doing here is we're saying, okay, well listen, bad news, Tom, yeah? We know that you made a big gain, but some part of it, yeah, is going to be exempt, but some's going to be chargeable, okay? So last one, calculate the chargeable gain by deducting the PRR, the private residence relief, from the original gain. In other words, we're sort of starting with the full gain up here, and we're saying PRR, yeah, based on the work that we do here, really ends up with us being able to extract from the total gain an amount that's exempt. We like exempt. We don't want to pay tax. But unfortunately, because you had a couple of years, yeah, that weren't covered, you ended up with paying some tax, some CGT on this massive disposal. Okay? I hope that made sense. A lot for you to take in. Anyway, practice, practice. Now, non-occupation. Yeah, we talked about deemed periods. Yeah, so really what we're saying here in this particular branch, yeah, is yes, there may be periods of non-occupation. He went to live with his mother. Let's say he went abroad to work. He went elsewhere in the UK to work. But in these scenarios, yeah, these periods of non-occupation are deemed as occupation. So in other words, when we have our little fraction up top, we would be including these deemed periods. This is good news. So we would add these to actual occupation. Okay, so what's the deal? There's several periods. Okay, first off, the last 9 months of ownership are always exempt, bar none. Yeah, the last 9 months. So I can always include them as deemed occupation. Okay, now outside of that, as long as, yeah, the following 3 periods, yeah, were preceded and followed by actual occupation, they can also be included. So, number 1, any period where the taxpayer was employed abroad. In other words, yes, actually, do you know what? In relation to Tom's case, in 1997, he went to work in the US. Yeah, he was just working abroad for 5 years. Okay, but after that, when he came back, he reoccupied the property. That period is deemed occupation. That period's covered. Yeah, we can include that period as deemed occupation along with actual occupation. Okay. Next one, periods not exceeding 4 years due to having to work away from home, either employed or self-employed in the UK or abroad. Okay. Outside of that, period 3, period not exceeding 3 years for any reason at all. Okay. Now, in terms of what's important here, memory. We have to rote learn these. We have to rote learn these, but be careful, because as it says here, the requirement, yeah, in relation to actual occupation, sorry, really here, must be preceded and followed by actual occupation. So each of these three, there may be one of them in play in the question, or possibly two, but they have to be preceded and followed by a period of actual occupation. They'll always be preceded, but not always followed. So think about it. If number one is in play, yeah, and our guy, Tom, goes to work in 1997 to America, yeah, for a couple of years, yeah, and then doesn't reoccupy the property, then that deemed occupation period does not count. It's not in play. It's not a period of deemed occupation. Okay? So, a fair amount to take in there, but, some rote learning is going to help in the first instance, yeah? And I'm talking about rote learning 1, 2, 3 plus the 9 months. Okay? I hope that makes sense. Different area now, lost or damaged assets. So far, we've covered a lot of ground. Yeah, we've covered chattels. Excuse me. We've covered wasting assets. Yeah, we've covered a lot of detailed rules. Okay, here what we're talking about is, well, there's an asset, but it's been lost. Yeah, or damaged. So in terms of loss or destruction of damage of an asset, really, in one sense, the basic area here is quite straightforward. So let's say we've got land, or buildings, or a chattel. So if it's basically destroyed, destruction, and there's no compensation, yeah, in effect, this will establish a loss. So, we had some chattels and they just got destroyed, for argument's sake, in a fire. They weren't insured, yeah. So I'm left with nothing, okay. Well, the revenue help us out. They give us a loss. What's the loss? Well, it's the cost. Yeah, because I got no proceeds, I had no compensation, didn't sell it. It just got destroyed in a fire. Okay? Now, next scenario, a little bit more complex. Loss or destruction with compensation. Yeah? So, yeah, the asset got destroyed in a fire, but it was insured. Yeah? So, there was some proceeds. Yeah? In effect, a capital sum. So that may well establish a gain. So look at the two different scenarios. One, no compensation, loss. Two, normally with compensation, probably a gain, just a normal disposal. Okay? Now, moving from there, damage to non-wasting assets. Okay? Now, note, non-wasting, e.g. land and buildings. It's not a disposal unless compensation is received, in which case the data receipt is the data receipt of the capital sum, or the disposal is data receipt of the capital sum. Okay? Straightforward. So, in essence, quite a few different areas there, and all specific rules relating to specific assets, whether it's land or chattels, etc., etc. Now, the bottom line is there's some element of rote learning, memory work to do in this chapter, for sure. We can't get around it. Are we going to be able to remember all of the situations 1, 2, 3, and 4 in relation to chattels off the top of our heads? No, I think let's memorize it. Okay? Are we able to remember, let's say, PRR in each of the periods of deemed occupation? Well, let's memorize it. Okay? I hope that helps and that your studies are going well. I guess we're sort of, just past the middle. Keep your head down, keep working hard. And thanks for listening to me.